When it comes to investing in infrastructure in the Asia-Pacific region, are boom times ahead? That's a question we posed as the title for our specially convened gathering of leading investors in the region back in August this year. The APAC region is experiencing unprecedented growth, underpinned by a rapidly expanding middle-class population. The Asian Development Bank projects a $1.7 trillion annual infrastructure gap, highlighting the urgent need and opportunity for sustainable infrastructure investment. What began as an idea for a small breakfast roundtable quickly evolved into a full-blown GIIA member conference. Our venue, Singapore, the rapidly growing hub for the world's largest investors to access the region. I'm Jon Phillips, and welcome to Talking Global Infrastructure, the podcast from the Global Infrastructure Investor Association, offering essential insights and access to key trends across sectors and geographies. Today, I'm joined by two partners at the renowned global law firm CMS, who played a key role in making the conference a success. We'll be discussing the critical takeaways from this landmark event and what's next for infrastructure investment in APAC. With me is Kristy Duane, partner and co-head of infrastructure at CMS, and Gerald Licnachan, a partner based in Singapore, whose focus includes energy, infrastructure, climate tech, and impact investments. Also with me is one of our conference panelists, Deepali Bahl, who is managing director at Augment Infrastructure. Deepali brings over 20 years of experience in infrastructure and private equity investments in emerging markets. Together, we'll explore the opportunities and challenges facing investors as APAC stands on the cusp of an infrastructure boom. So, Gerald, good to see you again after spending some time with you and the team in Singapore back in August. The conference that we pulled together was titled Investing in APAC, Boom Times Ahead. I think that was a pretty apt title for the conference from what I can remember. What makes this region such an attractive target for investors, and what are the key drivers for this optimism?
Great to see you again, John. And it was a fantastic event that we held in Singapore with so many leaders in the APAC infrastructure investment space. I mean, I think, as you heard at the conference, there is quite a strong consensus that boom times are indeed ahead for infrastructure and energy investment into the region. I'm certainly convinced that this is the case. I've worked in the emerging markets of Asia for 14 years now, and I've seen the development of the private capital investment into the region over those years. And although the market's still in a period of relative nascency, it's only really over the past 5 or 6 years where there's been large pools of capital seeking out Asian assets. I really do believe that we stand at the precipice of a boom in infrastructure investment in the region. And in terms of what's making the region attractive for international investors, I think the first key point is the size and the urgency of the investment opportunity. I think the ADB estimates that there's a $1.7 trillion investment infrastructure gap that needs to be addressed to allow the region to maintain its current GDP growth up to 2030. And, that's an incredible amount of capital that needs to be put in place. It needs to be put in place quickly. And 60% of that needs to come from the private sector. And we're only really seeing the very beginnings of that at the moment. And so that I think is a very attractive investment opportunity for private capital from the West and from the Middle East. I think another thing that's driving the sort of growth and optimism in the regional infrastructure market is that the regional governments are increasingly open to private capital. Some markets like India and the Philippines have a longer tradition of private capital investment, but I think other markets have seen how that's worked and are keen to replicate that success. We've seen a number of foreign ownership restrictions reduced, and also assets being offered for privatization, which is increasing the pipeline of assets available for investment in the region. And I think one other thing to mention is that the ecosystem for private investment in the region has significantly matured over the past 3 to 5 years in terms of the number of financial and strategic investors that are active in the region, as well as a number of government agencies that have been developed to help assist private investors invest into the region. I think at the conference we had people from across the DFI community, but also from the Singapore government, Infrastructure Asia were there. And they're really there to help catalyze regional investment and to help Singapore carve out its role as a regional hub for infra investment into South and Southeast Asia. So I think in emerging Asia, we've certainly seen the role that blended finance and impact investment, as well as the DFI investors, have made into the region. And that's really helped develop the pipeline of early stage projects, which other investors can then take forward. I think that's helped address a number of the market failures that we've seen, as well as, help develop the pipeline of talent in the region. So I think for those reasons, the exposure to the Asia infrastructure asset class is indeed very attractive.
One additional theme that I picked up from the conversation, Gerald, was around the kind of underpinning demographics of the region and this kind of growth of the middle class and the disposable income, I guess, that is driving some themes around urbanisation and consumption. And I wondered if you might comment on how that is perhaps driving some of the infrastructure sector growth.
Yeah, for sure. I mean, I think the latest projections are that 65% of the world's middle class will be in Asia by 2030, and that's an astounding figure. And this growth in the consuming class in Asia is really sort of driving governments to respond to their demands for better infrastructure and for more infrastructure. I think, residents of Jakarta may have taken their first metro trip or taken their first ride on a high-speed rail, and they want to see more of that. And I think as their consumption grows in energy, in digital, and in all other aspects of social infrastructure, they have the spending power and the political power to drive the demand for all asset classes of infrastructure across the board.
If I may add, John, to that, I think it's incredibly powerful that the countries in Asia have a fairly young demographic. For example, in India, the average age of the population is 28 or 29 years old. And that just means that there's a tremendous addition to the working population that's happening. That's supporting economic expansion, GDP expansion, and that's driving the need for things like power, roads, and so on. So this is kind of a secular factor that's behind the demand for infrastructure across Asia. It means that we can see this demand sort of sustain over a very long period of time, which is good news for investors in the region, because that growth curve is not something temporary. It's something that will, endure for some time. In terms of sort of elasticity of, for example, power demand to GDP growth, that factor is about 1.2x or so. So if you think about these countries having GDP growth rates of anywhere between 4 to 7% per annum for the next, 3 to 4 years, you could appreciate why the power demand looks to be growing between 5 and 8% in these countries. And that's quite a compelling statistic for investors in the region.
Absolutely. And I think, all of that demand is also part of the urbanization story. I mean, 60% of the Asian population is expected to be in urbanized areas by 2030. And I think one only needs to take a trip to any of the major cities in the region, to the airports, and to take a trip down the major roads and expressways that they have. We're seeing that surge in demand and its effect on the existing infrastructure, and really the need to grow and develop that infrastructure, because the demand really does outstrip the supply in a number of countries.
Well, thanks, Gerald. So I think that's actually a really nice segue into the next topic I'd like to cover, which is around the energy transition and decarbonisation. Obviously, these are global trends, but they do seem especially crucial in the context of the APAC region. Deepali, perhaps you could comment on what are some of the most attractive investment opportunities in the renewable energy space across the region.
Sure, John. Thanks for that. I mean, I want to say that I agree with you 100% that the energy transition in Asia is absolutely critical. And that's because, even today, 60% of the world's population lives in Asia. Nearly 50% of the world's GDP is generated in Asia, and 80% of the world's coal consumption happens in Asia. So beyond a doubt, this region is very critical in the energy transition equation. Because we've seen various government actions and legislation supporting energy transition in the region, we are seeing today several compelling themes. And I think it makes sense to bucket these into four categories. The first category is actually the most obvious and the one that's probably the most deep-rooted. It's renewables. So we've seen the utility scale solar business model in the region grow quite quickly, continues to grow. There's a deep set of opportunities here for investors to capture. But what's even more interesting is that within renewables, you're now seeing many more business model variations that are viable. I'd flag a couple. The first is distributed generation. That is increasingly being driven by both technology advancement and the introduction of open access regulation. So, for example, renewable energy sold directly to commercial and industrial users or C&I users has already achieved scale as a dedicated strategy in some markets. For example, my firm, Augment Infrastructure, has invested in a company called CleanMax in India, which is a leading C&I renewables energy provider. And the company has grown at a tremendous pace in the last few years. Also within renewables, I'd point to hybrid strategies, which have not just become viable, but highly economically lucrative, given the complementarity of solar and wind. So again, we've seen in India a large number of platforms have added wind to solar or vice versa because they see the benefits of having the higher plant load factors that are associated with hybrid portfolios. So I think hybrid is definitely an area to watch as well. The second bucket of opportunities is really relating quite directly to the first one, which is storage and grid investments. And obviously, the more renewables grows, the greater the urgency to modernize the grid and have storage solutions at scale. This is a space where there are some opportunities today, but I would expect it to really come of age in the next few years and to deepen very quickly. So it's a space that we are keeping close watch on. The third category of opportunities is in the energy efficiency space. And I think what makes this one unique is the fact that it's driven by large corporates around the world and their decision making and their behaviors, which is very focused on setting ambitious sustainability and net zero goals. They are looking now for solutions beyond green power, extending into energy efficiency, cooling, and so on. And we've come across some very well-run companies who operate in these spaces. For example, players who are specialized in providing cooling solutions to data centers, which is an energy-intensive business, and energy optimization is therefore a focus. We've also seen companies that are optimizing energy to telecom towers, for example, where historically diesel management may have been a key task. But now that you have much better grid connectivity in the region, the focus has shifted to solarization of these towers. So there's various strategies within that energy efficiency bucket that merits a close look because their growth is being spurred by the sustainability goals of corporates, and corporates are willing to allocate significant capital to that exercise. And then finally, the fourth bucket of opportunities that I would point to is really sort of a mixed bag of a few different sectors that are still quite early in Asia, but they hold good promise for growth. And these include sectors like green hydrogen, where we've seen many greenfield projects announced in the region already, EV charging, which is still at quite a nascent stage, smart meters, where India in particular has seen very significant tendering of contracts by the distribution companies. So all of these areas are extremely exciting. They probably need a good chunk of early stage or catalytic capital to de-risk the business case before a significant scale up can happen. But they also seem to be poised for very substantial growth in the coming years. So in summary, I'd say that investors looking to invest in energy transition in Asia have a very wide array of opportunities to consider from in the coming years.
Thanks, Deepali. And when it comes to specific markets within the region, how do you find the differences when it comes to putting infrastructure financing in place? What lessons can we draw from how these different markets approach the infrastructure financing discussion and challenge?
Thanks, John. I think that's a great question because a lot of the expense that needs to be incurred on energy transition needs deep lending communities or deep lending ecosystems. It needs sort of the broader chain of capital to work for energy transition to really scale. I'd say of the various markets in the region, India is one that I'll highlight as one that has matured at a pretty good pace for infrastructure financing. It's had, I think, for a long time, a deep pool of domestic capital. But we've seen in recent years that both foreign and domestic investors in infrastructure projects have really grown, both in number as well as in scale, as the underlying sectors have matured. And I'd say there's a handful of things that have worked well in India. The first thing is that from an infrastructure regulation perspective, there's been a decent amount of consistency, and that gives lenders a lot of comfort. Obviously, renewables is the sector that comes to mind within the broader infrastructure space, where the government started with various incentives such as feed-in tariffs, viability gap funding, etc. Then they transitioned to a reverse auction regime. They introduced open access regulation fairly early on. This was around 2018 or so, well ahead of some of the other markets that have done that in the region. There's now a big focus on ensuring that there's a regular cadence to renewables auctions so that there's some degree of visibility amongst bidders on what future auctions could look like. And this consistent development of policy has really helped deepen the investor and lending community. In fact, I'd say not only is project finance now available for the renewable space in India, but even taking on unsecured debt at the holdco level or mezzanine funding is increasingly feasible given the high level of predictability. So I think that's the first aspect that's worked well for India, consistent regulation. The second example that I would give is a thoughtful approach by the regulators to risk allocation. And again, this has resulted in both equity and debt capital flowing into infrastructure. One example is the roads sector. So in India, historically, a lot of greenfield risk was associated with the road sector because you needed to get rights of way. That involved dealing with government bureaus and government entities at different levels. And it was just a difficult process. So a few years ago, the government launched a program called the Toll Operate and Transfer Program, under which it bundled operating assets and auctioned these to private investors. For the private investors, this was a de-risked way to enter the road sector in India because they were buying operating portfolios with no greenfield risk. For the government, it was a good way to recycle capital away from these operating assets into greenfield projects. And of course, the government was much better equipped to take greenfield risk and handle rights of way because it was coordinating with its sister departments. So by ensuring that risk was allocated within this road sector in a way that was more acceptable between the government and private investors, the government effectively has catalyzed several billions of dollars of investment into Indian roads. And if you travel to India today, you'll see how many greenfield roads have been operationalized just in the last few years. So I think mindful risk allocation is the second thing that's worked well in India. And then the final thing I'll mention is that the government has been very aware of the fact that for investors to feel comfortable to continue deploying big checks into these capex intensive businesses, they need to see that infra investing in the country is a full cycle business, meaning not only is it important for investors coming into the country to have the right frameworks, but they also need to see clear mechanisms to realize value, to take their money back. And to achieve this, a few years ago, the government introduced this infrastructure investment trusts, or InvITs structure. These are regulated entities by the Indian SEBI, which is the equivalent to the US SEC. And under these regulations, what companies can do is spin off cash generating assets, operating assets, into these InvIT structures, which are effectively designed to have appeal to yield investors because they require the payment of certain dividends. Today, there are approximately 20 such InvITs in India, which shows that this has been quite a successful strategy, enabling capital providers to take capital back and complete the full cycle of investing. So I think these are the three things that have been done well in the Indian space. There are other examples in Southeast Asia of things that have been done well, but I'll stop there.
I'd have to wholeheartedly agree with you, Deepali. I think India is often cited as the poster child for how to get private infrastructure investment right in the region in terms of the market maturity, regulatory certainty, and the scale that India offers to investors. And I think we are seeing other regional governments look at the success that India's had in that space and look to try and replicate that. And in other aspects, because the Indian market has been so successful in creating platforms and other developers and operators in the space, we are actually seeing quite a lot of Indian talent move from India to Southeast Asia to try and plug a talent gap that some of the markets in Southeast Asia have. So it really is a strong success story for Asia.
So, Kristy, I'd like to turn to you now, if I can, and to pick up on perhaps some of those themes around regulation and risk, and really just to dive into the fact that there's such a diversity of cultures and regulatory environments in the region, which obviously poses challenges for investors in terms of how to navigate that. How critical is it to have local teams on the ground? And can you share any success stories about how that kind of local expertise has made a real difference?
Yeah, sure, John. Happy to pick that up. And I think how critical is it to have local teams on the ground for these matters? I think it's crucial. You obviously need people who have infrastructure development and investment expertise, but you also need that group to be able to deal with the local language and culture, but more importantly, the political landscape and regulatory framework. Each of the countries operates in quite a different way, and there's often nuances that really only local team members can manage. And historically, I think there's probably a number of stories that are not success stories, John, where investors have come into the region and really bear scars from their investments which have gone wrong because they didn't embrace this regional diversity and weren't set up where they had local teams looking at particular countries with that sort of laser focus that we now see. In terms of success stories and where we've seen local expertise really make a difference, I think there are probably hundreds of them, and others might be able to share their experiences. But we've certainly seen in the context of M&A and Gerald picked up on FDI regulations previously, but having local teams who are familiar with the regulator, who have dialogue with the regulator on a regular basis and are able to engage with the regulator early in a transaction has certainly been helpful for us. I think that early engagement allows the regulator to be properly briefed and not seen as sort of brought into the picture too late. So in terms of transactional activity, I think, again, it's key that relationship with regulators, which is frankly the case in all markets, but particularly helpful in APAC.
And just to add on to that, I think in terms of, outside of the regulatory and political risks, I think having a local team on the ground is essential to be able to access deal flow. And there's a lot of competition for investable assets in Asia, a lot of money chasing very few assets. And so I think having boots on the ground really does help access at an early stage the various opportunities that arise in the various markets. And in fact, a number of our clients who are establishing brand new renewables or other investment platforms for Asia, although they'll establish the hub out of Singapore, they very quickly turn to establishing regional offices and getting those offices staffed with people who have the requisite experience, as Kristy mentioned.
And Kristy, you and I speak a lot about the themes of ESG and sustainability in terms of the work of GIIA and our ESG working group, which you play such a prominent role in supporting us. How does the ESG and sustainability agenda play out in APAC? Is it just as important as how it is seen in other markets around the world?
Yes, look, I think it's probably as important, if not more, John, in APAC, and that's for a couple of reasons. Sustainability and climate adaptation is key, firstly, for mitigating climate risks, but also for enhancing economic resilience. And we all know the APAC region is particularly vulnerable to climate change impacts. We've seen rising sea levels and extreme weather events and other natural disasters really take an effect on the region. And this is where, if we see sustainable infrastructure projects, they can really help mitigate these risks by incorporating climate resilient designs and materials and all of the items that are needed to really mitigate against these features that we see with climate change. But not only are we looking at mitigating climate risks, as I said, we're also looking at economic resilience for the region and sustainable infrastructure and renewable energy, efficient water management, sustainable urban development and the like. They all really do contribute to long-term economic stability and growth. And so I think for APAC, that's where sustainability plays a particularly important role.
And just to add to that, I think because emerging Asia infrastructure is very much a greenfield market, what we're seeing is that some of the early stage sustainable infrastructure or renewable projects are receiving capital from impact investors or from blended finance providers, which is actually inculcating ESG and high ESG standards right from the beginning. And so in some ways, and then in some markets, Asia is ahead of other markets because of the fact that, a lot of these assets are being started or being developed from scratch, but with investors who have high ESG expectations and involving teams that are sort of ESG first or have an ESG or impact angle to their investment strategy and style.
So would it be fair to say that not only do strong ESG sustainability credentials give investors an advantage in terms of perhaps the pool of capital that they can get their hands on, but also reputationally with politicians and regulators, just in terms of, getting themselves into the leading positions for when it comes to bidding and deal flow generally?
I think, John, that's always been a feature, hasn't it? Government is always keen to see private capital providing solutions to some of their problems, and large-scale infrastructure has always had these sorts of issues associated with them, and private capital is often the ones who are able to provide the solution. So, yes, I think it would always make a bid more attractive if you're able to demonstrate how you're satisfying ESG criteria, and, as I say, probably most importantly, indirectly helping governments achieve their own targets such as net zero and biodiversity and the like.
I think one of the things, John, that will also add to the momentum that we're seeing in, whether it's renewables or EVs or any other space in the sustainable kind of infra area, is the fact that there is increasingly commercial reasons why these make sense. So I think for solar, everyone is well aware that in many countries we're now at grid parity or better than grid parity. And even at those levels of solar pricing, or solar tariffs, investors are making really good returns. So there's a commercially profitable model that's attracting more and more capital into solar, for example. Similarly, we are hearing with EVs that the total cost of ownership is actually declining very quickly. The cost of ownership of EVs, the cost of operating an EV has always been lower than operating an ICE vehicle. But also the entry cost is going down. Financing is now becoming increasingly available for EVs. And I think all of those things allow for these sectors to really get on a path that's quite sustainable from a growth standpoint. So I think those will ultimately also drive the growth of these industries in Asia.
And just to add from a sort of exit angle, I've certainly seen in my experience of acting on the sell side instances where an ESG premium becomes payable for assets that have had ESG focused investors from the outset. I think to the extent there's not many assets like that, but that there is a growing supply of them. And I have seen those assets obtain higher prices because the ESG reporting and ESG standards have been included right from the beginning, and it can be demonstrated in the data room.
Well, that's fascinating. Thank you all. We touched on this back at the conference where we acknowledged, I think, how difficult it is to do justice to a discussion about the whole APAC region in such a short space of time, because it is such a multifaceted theme with so much diversity within it. And the danger is that one tries to generalize about the region to the point at which it's not an informative kind of discussion. But I think you've really helped, to break that down into something that's really interesting to follow. So I appreciate that. And I'm sure our listeners will too. So I think we're coming to the end of our time slot. And I just thought maybe we could close by inviting you each to share one or two sentences about how you see the outlook for the APAC region over the next 12, 18 months or so, the challenges, the opportunities, or just generally, what should we be looking out for? Gerald, let's go to you first.
I think from where I sit, the biggest opportunity that I'm seeing is in digital infrastructure. The boom in AI globally is having its inevitable effect in South and Southeast Asia. And the constraints on power and water mean that primary markets for data centers like Singapore are tapped out. And so we're seeing huge investments planned and which are materializing in secondary markets like in Johor and the Riau Islands, both in Malaysia and Indonesia. And, with these sort of very high-end, high-spec data centers comes a huge demand for renewable power as well as water. And so, the investment is not only in the actual data centers themselves, but also the ancillary infrastructure. And I think power is going to be the major constraint in the region, especially as it's very hot and humid. An additional amount of cooling is required for data centers here. And so I think that really is the space to watch, given how much more computing power is required in the region where we're already behind in the digital infrastructure journey.
And Deepali?
So I think distributed models are interesting models to keep an eye on. I mean, we've already seen that happen in the renewable space with businesses focused on commercial and industrial users. They're selling green power directly to them. We are seeing this theme come up in data centers as well, with edge data centers. There being a huge demand for them, where the build is really focused on hyperscale. So there's, I think, certainly a space to play on the edge data center side. And the reason why distributed models are interesting is not just because of the demand for them, but also because they present diversified risk. You have, risk across multiple sites, multiple assets, multiple clients, etc. And so it's a better risk profile in my view. The other theme I think that's interesting in these markets is mid-market infrastructure. And by that, I mean equity investments in the 50 million to 150 million check size. You see a lot of activity in the sub $50 million range from impact funds, DFIs, etc. And then in the $200 million plus range, you see the sovereign wealth funds, the pension funds, the mega infra funds. But the mid-market is what's underserved. And that's actually really quite a deep opportunity set, because you have a number of businesses that have shown some proof of concept. They have some operating asset base, and they're looking now to scale up to the next level. They're not quite on the radar of the mega infra funds yet, because they can't digest that amount of new capital. So I think those are good businesses to target as well.
And Kristy, the last word comes to you.
Thank you, Jon. Well, I would probably close with focusing on management teams. I think for both the teams operating locally and investors operating in the region, I think there needs to be a real recognition that people are focusing on nurturing and growing these pools of talent and developing management teams who are, I guess, what we would call investor ready. So they're agile and dynamic and have the flexibility to deploy capital, but are especially able to operate across all of these different countries and can adapt to different requirements in each country. So I think I would probably leave everyone with just realizing that will create a demand and supply imbalance. And I think you need to be on the front foot with acknowledging that there's going to be quite a lot of demand for talent, and to keep that in mind in your investment strategy.
Well, thank you all. That's been fascinating, and really appreciate you sharing your thoughts on this podcast, as indeed we did with the fabulous event that we worked together on in Singapore earlier this year. So thanks all, and speak to you soon.
Thank you for joining us on Talking Global Infrastructure. You can find useful insights, case studies and reports on infrastructure investment on our website, GIIA.net. Make sure to follow us on Spotify, Apple Podcasts and YouTube so you never miss an episode. You can find us on LinkedIn and join our mailing list for the latest news from the sector. And if you've an idea for an episode, thoughts or feedback, then you can email us at communications@giia.net. We'll see you next time.